Welcome back to the CNBC TV18 special, The $1 Billion Baby. The fund we are discussing is the Motilal Oswal mutual fund, and the authors, the fund managers of this fund, Raamdeo Agrawal, Manish, Sonthalia and Taher Badshah have been speaking with us. Well, the oil and gas space, you've very correctly been betting on the oil marketing companies and avoided the upstream companies. What was the rationale behind this, and will you stick with the strategy?
The downstream companies is where the franchise value is significantly higher. If you look at these retail franchises like HPCL, BPCL, etc., they are the ones which are the most durable. As we discussed internally as well, that these are businesses, actually retail businesses that you would like to be in. There are no alternative kind of businesses, real brick and mortar retail, but no option. You can't actually do online buying of petrol and diesel. So, then there are only 3 or 4 players in the market, and these are guys who have now seeing a significant transformation in the business value because earlier they were denied the due profitability that they should.
You wouldn't ever go upstream. You don't see too many positives in those companies.
So, we still have the issue of the whole oil price, the under-recovery burden, which is still going to sting them. And we need to see a situation where they get completely off it. If that happens, then of course there is a good amount of franchise value, especially at current levels, even for some of these upstream companies.
Manish, you have comments in your portfolio. It came out with numbers, and after a long time we saw the kind of rally. But overall, as a space, would you stay invested in names like Cummins, Voltas, and do you think the earnings recovery that we have started to see, is that sustainable?
Absolutely. One of the themes that we in the PMS that we are playing on is the Make in India theme, right? Of course, India will move towards a self-sufficiency in the power situation. That could mean that Cummins as a primary backup power, the volumes would take a beating, and the lower HP would have lower margins. But the Make in India themes means that they can manufacture here and outsource to the rest of the Cummins subsidiary all over the world. The 60-liter engine is now being exported to China. That is seeing huge amount of traction. The mining segment, that is just about, what Coal India's production targets are for the next 5 years, doubling of production. It is consumable engines. So, as opposed to what the market believes, what is the growth trajectory, we significantly deviate from that opinion, and we've seen the numbers how they are playing out. In spite of a gross margin contraction, the volume growth has just taken care of the entire the growth trajectory. It's been very strong. And similarly, consumer discretionary, now 21% market share in the room AC business. You've seen the margins, what we have seen, in spite of the industry going through a slowdown. I think FY17 for the industry as a whole should be a pent-up demand both from FY16 and moving into FY17. So at least, I'm convinced about the growth. Let's see what the numbers are. Till now, they have delivered. Okay. We'll evaluate the situation, how it goes.
Okay. One philosophical question for you, and then more stock-specific for you all. What we are now seeing is a fairly broad-based mid-cap rally. You all have preferred to choose, in your fund, 50 stocks which you all monitor very closely. You change that philosophy?
No,
change the stocks?
No, it's a focus. See, this is a focus strategy. This is part of the QGLP process. You can know, as a fund manager, you can know very few stocks. Okay. It's impossible to know 70, 80 stocks. That is the core of the philosophy that we, in fact, if you see the names, we have chosen the names Focused 25, Focus 30, Focus 35. It's a focus series. So, though we have taken permission for 25, 30, 40 stocks, we don't invest in more than 17, 18 stocks. 20 is absolute Lakshman Rekha. Okay. So we don't have, and we are going to maintain that, and that may constrain. That may bring some kind of capacity constraint, how much money we can take till the performance gets hurt. But still, the promise is that we'll remain focused. We'll have fewer companies, and we'll have a chunky allocations to the. Because if you have convictions on the stock, you have to buy 8-9%.
Okay.
With 0.5%, 1/4%.
Then why are you getting out of Power Mech? You had 22%, you are now only
That's
2%.
a different question. That's not part of the mutual fund. That's in private equity, and that fund is coming to an end. Actually, the tenure is on extended period. We have to wind up the fund by December 2016, and we are going to line up 10 more IPOs in next 1 year. So clearly, this is. These are the best pieces of the businesses which we are selling right now. So clearly, I'm under compulsion to sell it off, and good that markets are a little warm, so that we can, kind of offer to the public. But it is under compulsion that we have to sell.
Taher, really have to ask this one. Your biggest, stock has been Maruti. We've been talking about this, and you have been bullish at all levels on Maruti. Yeah. Is this still a yen story playing out, or do you see a volume growth story as well over the next few years? And would you stay invested in a stock like this, or would you add more at current levels?
No, we are up to our limits as far as Maruti goes in our fund. So, unfortunately, we can't buy beyond that 10% limit. We've almost gone to 9.9, whatever that number is. So, so I think, so we remain extremely positive. I think the company has done its bit in terms of ensuring a very, very healthy product pipeline. They have probably benefited out of the currency much more than many others in the business. But at the same time, I think now going forward, the story is going to be more about the top line and the growth and volumes. Plus, market will be keenly watching their success in the higher end, because till now it has always been perceived that Maruti is essentially about small cars and compact cars, and yes, it is. Even probably for the next 10 years, it will remain so. But clearly, they are adding on to the new piece. They are taking steps in the right direction. Separate brand, separate suite of products coming up, and it remains the most profitable enterprise. So their ability
I was reading somewhere its market cap is now higher than Suzuki's itself.
I think Suzuki itself is all about Maruti India. So, it's not surprising in a way that stock is hitting new highs in sync with what's happening to Maruti Suzuki India. So I guess it's always been so, but now the true color of the value of the business is emerging. So we were fortunate to actually get a lot of it in the distress of the last 2-3 years when a lot of problems were happening with the company. So it is this about buying some very good quality companies in distress, and then you make some supernormal returns.
Okay, your most interesting stocks for the next 1 billion opportunity or 1 trillion opportunity. Manish, you have DCB. Would you prefer it over Kotak Mahindra? You have specialty restaurants. Would you prefer it over Jubilant Foodworks? Why these?
So see, a company has a breakup value, a franchise value, and a growth value, right? And out of these three values, if there is a less than fair value that is coming out in the stock price, there's an opportunity. So at 600 odd crores market cap, whether specialty does have the room to grow, does the franchise value represent a value much superior than what the market cap is? Because traditionally his ROEs and ROCs have been quite good. So it's a play in the consumption space, dining out, this has gone through a slowdown. That creates an opportunity. If we talk about a DCB, is it the next HDFC bank in the making? Everything begins with a small, 10,000 crore book, 3,000 crore market cap. I think the credit appraisal is their chief competitive advantage. Okay, and it's the Aga Khan
Foundation. Of a bank.
Absolutely, it's the Aga Khan Foundation, which is the promoter, and which also promoted HDFC Bank. So that learning is there, right? So, and you are able to grow your balance sheet 25% with minimal NPAs. That is all that we need for a bank to do right. And if that comes, markets are okay about it.
Okay, Raamdeo, really have to ask you this one. How do you play a story like Nestle? Because, there's this whole scarcity premium, of course, in terms of equity. But, 25% of your business is going through the kind of mess that it's going through. Good opportunity right now for Nestle, or would you rather let it pass and look at it later?
I'm really surprised by the price movement of Nestle, despite once in a 30-year kind of a loss, and yet the brand is not back on the shelves. Now I think there is a much higher move. I can see much more sympathetic statements in the headlines today, but yet the permissions are not come, brands are not back, and it hurts a lot. This kind of brands out of the shelf for a long period. And despite that, it's almost all-time high, 67, 66.
Practically,
so market has voted with full confidence. See, with the current valuation, it will be a very average return. Even if the company does very well. But longevity, if you want 15-17% return for next 20 years, 25 years, you can buy even at current price.
So a pension fund should buy.
Yeah, it's actually fit for a pension fund, and probably it will be an index return. If index has done 17% for last 34 years, clearly it would match or probably be 2%, 3% higher. Because you are buying at 65, 70p, even if you talk about the normal P. So So I think it's a very long term, very good investment, but it is not a multi-bagger by any stretch of imagination.
That's it on the CNBC TV 18 special, The $1 Billion Baby. Thank you very much for watching from me and Anuj.